Good morning, everyone, and welcome to today's webinar, Interesting Twists on Lowering Borrowers' Payments. Now, as questions come up throughout the webinar, as I'm sure they will because we've got lots and lots of great information to go through, please go ahead and use the questions function throughout as the questions occur to you. And at the end of the webinar, we will be doing a Q&A and we'll go through all of your questions. With that, I am going to turn it over to today's speaker, Mark Luzzi. Take it away, Mark.
Good morning or good afternoon, everyone, depending on what part of the country you're in. My name is Mark Luzzi. I'm a regional sales manager here at LendSure, and I'm up in Orange County. I'm happy to be speaking with you today. So what we're going to talk about is structuring loan options using a combination of interest only, rate buy down, and stacking. Stacking might be a new term to you that we're going to teach you if that's the case. We're going to talk about using a 40-year interest-only option to optimize the investor cash flow ratio, get more DSCR loans to actually qualify. We're going to talk about lowering the DTI to help your loan qualify using interest-only payments while not increasing your interest rate. Well, that's kind of defying gravity, but we're going to teach you how we're going to actually do IO loans without increasing the interest rate to do so. We're going to talk about lowering rates without bringing in additional cash at closing. And then at the end, we're going to allow you to ask some questions, and hopefully our co-founder, Joe Leiden, will have some answers for you. That would be great. And so let me talk to you a little bit about us. We were founded in 2015. We're headquartered here in San Diego. We have 2 additional regional centers. One is in Rhode Island, one is in Georgia. We have a highly experienced non-QM management team that has been together for over 20 years, and they've worked together in a couple of different mortgage platforms. We're currently lending in 40 states and growing, and so all that is pretty exciting stuff. So what is it that we do? Well, LendSure focuses on loans with solid benefit and performance. So what does that look like? Well, we serve the A-paper credit-worthy borrowers that you guys talk to every day, but for one reason or another, they're not qualifying with your current programs. So we offer programs like bank statement loans, asset depletion loans, investment property, cash flow or DSCR products. We're going to get into that a little bit. What do our loans look like on average? Roughly a 700 FICO score and roughly a 70 LTV or less. Those are the types of loans that we have been financing for the last 5 years. So what we don't do is we don't compete with you. We don't do any Fannie, Freddie, FHA, or VA loans. Not interested in foreclosure bust outs, second mortgages, or home equity loans. Everything that we have on our product menu is intended to be added value for you and your borrowers. All right, so before we get into borrower pay compensation, I just want to talk to you a little bit about how our industry competes with each other. We all have our products. We work very hard at LendSure to have state-of-the-art products. We all have pricing. We compete on price, and we all know in our industry how important that is. But lastly, we compete on service, and we have hands down the best service in the industry, I'd like to say. But we also developed a 4th platform to compete on, although there's nobody else doing it yet. And this is some of the things that we're going to talk about, and that's our ability to stack as well as your borrower paid compensation. So these are additional pieces to our lending platform that make you as a loan officer more competitive by working with LendSure. So normally, in a normal situation for a borrower paid comp, your points would be paid for by the borrower. In a purchase, that would mean that the cash to close would be by the borrower, bringing your compensation to the closing. In a refinance, the cash out would be reduced by having to pay the closing costs. So what makes it special about LendSure is that your borrower paid comp can be stacked on top of the loan. It reduces the borrower's cash to close, and it also gives the borrower the maximum cash out available in their cash out refinance. So keep this in mind as we demonstrate this through a few loan examples coming up. I want to talk to you quickly about our interest-only features. We have 3 options. The first one is a 5-year IO with a 25-year amortization. The next one is a 10-year IO with a 30-year amortization. But the one that we sell the most of, and the one that has by far the most benefit, is that our 5-year and 30-year fixed programs are actually the same pricing currently today. And based on that, we have an IO for a 40-year term, which is 10 years of interest only on a fixed rate, and then that fixed rate stays the same and converts into an additional 30-year fixed rate loan. So it's a full 40-year term. And you get all of that for just a 0.25 add to rate on a 30-year fixed, or a 0.5 to cost. So let's talk a little bit about a debt service coverage ratio loan. For those of you who may not know what that is, it's for investors only. It's qualified by the rental income divided into your PITI. So we take either the rent or the rent or a rent survey, whichever is less. That's what we're using for us to find that ratio. When you divide the rents and the PITI, that's going to give you your DSCR ratio that we use to qualify. Now, currently, our ratio at LendSure is 125. But I have some good news for you. I'm actually able to announce this right now that on August 1st, our ratio is going to be lowered to 110. That's actually probably the best in the industry that I know of today. We're really excited to do that. So these loans actually make a lot of sense because we don't ask you for tax returns, we don't ask you for bank statements for income or even W-2s. It's minimal documentation, and the loans actually move very fast. We're able to close those loans in 10 days or less in some cases. Combined with interest only and rate cutter, which I'm going to get into, this is a very powerful tool for your client. So I want to show you a loan example that we actually just recently saw in my region. So I'm going to give you an example of how to get this loan to qualify. It's a DSCR loan. It's a 30-year fixed payment. Purchase price is $879. Loan amount $571,350, and you're at a 65 LTV. Your FICO score is 760. Your interest rate on my rate sheet would be 6.875, and your term is a 30-year. Payment $3,753, and then you throw in the taxes and insurance, $4,815. And the rent survey came back at $4,886. Now, that's pretty much a break-even situation for that property owner. The debt service ratio is 101. Couldn't get the loan to qualify. So we looked at, well, let's add an interest-only payment into the scenario. So my loan amount stays the same. The loan to value stays the same, FICO score, but my interest rate has increased to 7 1/8. My term stays the same. My payment is $3,392 now with a total payment of $4,454. And you divide that into your rent, you divide the rent into the PITI, and your ratio is now 110. Based on my announcement, August 1st, that loan would qualify. So we got the loan to use, we got to be able to utilize the payment on the IO just to get the loan to ratio. But our current guideline is 125. So I'm going to use the DSCR plus my rate cutter option. Let me get into this. My purchase price stays the same, but my loan amount has increased. You can see it's increased almost $15,000. Why? Because I took 2.5 LendSure discount points and I reduced the interest rate to 5.875. What I did was I lowered the overall interest rate 100 basis points with my 2-point buy down on a 2-to-1 ratio. And then I additionally bought out my IO adder for a 0.5 point. Now, by doing so, I also converted it into a 40-year interest-only loan, like I described before. My total payment now is $3,929, and when I divide my rent into my PITI, my ratio is 125%. So I got the loan to qualify on my current guidelines by adding in my rate cutter and IO as an advantage, but also look at the actual cash flow we've been able to generate for this property owner as an investment. It's spinning off close to $900, almost $1,000 in income per month, whereas if you were to go back to the 30-year fixed option, it's a break-even situation for income. So just want to show you the power of that in that program. Okay. So moving on over to rate cutter. What is rate cutter? So rate cutter is discount points with a special ability of being financed into the loan at no additional charge. It increases your loan size without any penalty for moving into a new LTV bracket, which would affect your pricing. So if you're pricing a loan at an 80 LTV, when you go into the next bracket at an 85 LTV, that's what the essential benefit of rate cutter does, is it keeps you at the 80% pricing, even though that you're at 82 when it's stacked. So what does this mean for the borrower? Lower interest rates, lower payment, lower total cost of the loan with less interest paid. Those are all key factors. Now, the limitations, I want to make sure you understand. 80% base LTV or lower is the maximum that we can stack. We do have 85 LTV programs, so please don't get confused, and your account executive will help you with this as you build loans together. 80% is currently the maximum that we're able to, as a base loan amount, stack. We can stack then up to 82. The price remains the same as you were on an 80 LTV. The ratio, like I mentioned before, is a 2-to-1 buy down. So a half interest rate point would equal 1 point of discounts. Up to 1% rate reduction for 2% is the maximum. You can buy down 100 basis points of rate. Now you can do that and also combine buy downs with rate adder buyouts. So, for example, in this case, we bought the interest rate down 100 basis points, but we also bought out the IO adder. We converted that into cost. So, in a sense, that was very powerful for your borrower. Watch out for your floor rates. All floor rates are the posted lowest interest rate on all of our rate sheets that have the upper left-hand corner box. So they're pretty easy to identify. You cannot buy down interest rates past our floor. Okay, so here's a purchase example with rate cutter. The scenario, it's an 80 LTV purchase, 720 FICO, and it's borrower paid comp. So our starting loan amount with rate cutter is 500. The industry standard as well, 500. Your par rate 6 1/8 on both options. Discount points. So the borrower's interested in a much lower interest rate. So you offer the rate cutter option and charge 2 discount points of $10,000. Your new rate's 5 1/8 versus 6 1/8. Your new loan amount with rate cutter is $510,000. Your borrower stacks the $10,000 on top of the loan. And as you can see, even though that I have a higher loan amount, my interest rate's less. And what happens with this is your actual payment savings you've generated by doing this is $262 a month. Now, by doing that, your annual interest savings, payment savings is $3,144. And as they stay in the full life of the loan, that's nearly $95,000 you've saved them. Rate cutter can be very powerful. So here's a purchase example with rate cutter continued. What do we see? So borrower's interest rate was reduced 100 bips at $10,000 cost, and they did not have to come out of pocket with that at closing. That's very powerful. If you look at the recapture period, it's basically about a 33-month recapture where the $10,000 in cost is paid for by the payment savings. The future equity of just buying the home and the normal appreciation rate of that area, even if it was only 4%, in 6 months, your future equity's already paid the cost of the $10,000. So what's the rate of appreciation in your market? You want to be factoring that in as you are using this as a tool to help your borrowers save money. The following 27 years, well, it's all savings. And as you can see in this situation, we saved that borrower $95,000 in the full term of the loan. Okay, so here's a purchase example with rate cutter and borrower paid comp. So we're going to combine your comp, and we're also going to use rate cutter to lower off the interest rate. Okay, they both have $500,000 starting loan amounts. They both have 6 1/8 interest rates, both LendSure and our competition. The LO is charging 2%, $10,000 on both loan scenarios. With rate cutter and the borrower paid comp option, the loan officer chose to stack the $10,000 of compensation and go to a 510 loan amount, 81.6 LTV. Our competitor, not available. So it's still a $500,000 loan amount, 80% LTV, bringing $10,000 cash to close. Rate cutter, we also want to reduce the interest rate. The borrower isn't happy with 6 1/8. They want to be in the 5s. So we reduced the interest rate a quarter with a half cost, okay? and we got the interest rate down to 5.875. Our competitor is still at 6 1/8. The new loan size LTV is 512,500 at an 82 LTV. So I combined the comp and the rate cutter to 2.5 points. That brought us to 82 LTV. My competitor still at 500,000 and an 80 LTV. So the closing cost, we increased the loan amount 12,500, covered the borrower paid comp and the discount point. The new payment's 3,063. It keeps 12,500 in the bank for your borrower. And as you can compare the two payments, we're $3.56 less than our higher interest rate, lower loan amount option from our competitor. So I hope you see the power in that. I know your borrowers will if you're able to produce this correctly. Okay, a purchase example with rate cutter and borrower paid comp. This is the continue. Hang on, my slide. There we go. Okay, so to recap, we were able to put not only your compensation into the loan, but also reduce the borrower's rate by 25 basis points. This saves the borrower significant closing costs and interest on their payments. The other benefit to consider with this is the ability to defend against tight debt ratios. So by allowing the rate cutter, you're able to get a borrower with a 51 debt ratio, possibly to be able to be approved in the 49s. By not bringing the cash to closing, you can now utilize that cash as additional reserves or just meet your reserve requirements altogether. Your asset calculations can be softened by using this option as well. So it frees up your assets. So more loans can be qualified, more borrowers can acquire the homes that they want, and there are less no's from you to your clients. So I know that they would appreciate that. Cash out refinances. So let's get into how we can use rate cutter and borrower paid comp with a cash out refinance. Let's do one at 60% LTV with a 700 FICO, and again, borrower paid comp. It's a different loan size, so we're at $375,000 for both us as well as our competitor. Now, let's get into how we got into our 6 1/4 par interest rate. The base interest rate was 5.75. We added a quarter for cash out, and we added a quarter for interest only. So our total interest rate was 6 1/4. Our competitor interest rate actually priced out differently. They have a 6% interest rate. 5.75 was their base, and they just did a quarter cash out add. They didn't do the interest only. The LO comp is the same, 2%, $7,500. The new loan amount for LendSure using the rate cutter option is $282,500, which equates to 61.2% LTV. That's stacking the LO comp into the loan amount. Our borrower, our competition, doesn't have that ability. So that $7,500 still being brought to the table for closing costs. Loan amount still $375,000. So let's remove the adders and convert them from rate adders into closing costs. We're going to be able to stack those. So what we did was we changed the half rate adder, half a point, and we converted that to 1 point cost as a discount point. And we were able to build that now into a stackable point for a total of 3 points. So that's 2 for the loan officer's compensation. That's 1 point for LendSure as a rate buy down. The 3 total points gives you a new interest rate of 5.75. Again, that's interest only. The new loan size is $386,250, and I'm within my requirements of 61.8% LTV. My competitor is at a 6%, 30-year fixed, still a loan amount of $375,000, and still at a 60 LTV. So the borrower with us in this option with rate cutter gets the cash out, the full cash out that they requested. Competitor actually has to deduct the $7,500 in cost from their cash out. The payment from LendSure is $1,850. It's an interest-only payment, and the payment from our competitor is $2,308. It's a significant difference, not to mention that payment savings for interest only is for a full 10 years and then converts into a 30-year fixed. Cash out refinance continued. So that's a lot of numbers. What are we looking at? The borrower gets cash out loan with a standard purchase rate. In a comparison, we don't have the cash out adder. All adders for cash out and interest only were bought into the loan, and they will pay themselves off with a reduction in interest in just a couple of years, looking at the recapture period. You have a lower payment overall, especially for the first 10 years of IO, but most importantly, the LO comp was added into the loan versus it being taken out of the available cash out. At closing, the borrower did get the requested cash out in full. Okay, benefits of rate cutter. For investor loans, we talked about the overall DSCR ratio being the qualifying mark and how we're able to use interest only to meet those requirements. And again, on August 1st, the DSCR ratio for LendSure is moving to 1:1. We can buy out nearly all the adders associated with this loan type, as well as any bank statement or full doc option. Rate cutter allows you to convert rate adders for program needs into points. The reduction of interest rate lessens the burden for DTI. We talked about how we could get more loans to qualify that way. Lower payments for your borrower. Incredible savings over the life of the loan. A good exercise would be pull a loan in your pipeline and reduce the interest rate by 100 basis points and compare the total interest over that life of loan as a selling point if you were to use rate cutter. Key points to note: the lower the starting, the lower the starting LTV, the more ability we have to stack rate cutter points. So I'm going to give you an example. At 80 LTV, we can stack 2.5 in points versus at 50 LTV, we can stack all the way up to 4 points. So here is a table that kind of describes how this is a variation. On the left, it shows loan amount. On the right, to the right of that, it shows you the value and the loan to value that's created. The stacked LTV are all 2% higher than the available LTV. The exact points I really don't want you to pay that much attention to. It's the real points. These are rounded off numbers that we can help you maximize rate cutter, borrower pay comp, and all of your rate adders and convert these into stackable points to reduce the interest rates, to reduce payments, lower overall interest of the life of the loan, how to use your future equity to pay for these closing costs. And I hope you guys see the power of these tools. So with that said, I'm going to hand this over to Rose. She's going to talk a little bit about our private label resources and how you can actually put some of this stuff on display for your future borrowers. Rose.
Thank you, Mark. So LendSure has prepared a nice solid kit of marketing resources that you can download and you can customize with your logo, with your disclaimer, with your contact info, so that you can start reaching out to new markets today. These include private label flyers that you can print out or send out as attachments, banners so that you can use these on social media, even postcards that you can send out through the mail, and Outlook email templates. All you do is add your logo, add your contact info to start bringing in new business. If you have any trouble with these at all, reach out to your LendSure account executive. They've all been trained on these. They can be a little bit tricky sometimes, but with customizing and adding your info, but not to worry, your LendSure account executive is there to help.
Thank you, Rose. So I'm just going to talk real quickly about our process flow and how to do business with us. First of all, your account executive is a highly trained individual that's able to help you structure loans on the front end, use them as a resource to help you do that. Secondly, we actually have a pre-qual process that we work with regarding bank statement loans. Actually, all loans go through the process, but when we're through with the pre-qual process, we actually have determined the income that we're going to allow you to use on a bank statement loan. It's tremendously helpful knowing that the loan that you're going to disclose to the borrower and submit to us for a final underwrite is actually going to be an approvable loan. From there, once the underwrite is actually done, you're introduced to our account management, and those people are designed to move that loan from a loan approval through the conditions, CD, close, and fund as fast as possible. You'll find our service to be very friendly and efficient, and our goal is to be, regarding turn times, is to be turning around your approved loans within 10 days from an approval basically to a funded loan. So with that said, I'm going to turn this into questions that you might have, and I'm going to allow Joe Lydon, our company co-founder, answer them for you. I know Joe loves talking about this stuff, so he'll definitely have some answers for your questions. So here you go, Rose.
Thank you. So I've got a couple of different people asking if the slide deck is going to be available. Yes, keep an eye out. In about an hour, I'll send out a thank you email, and it'll include a recording of the presentation, and it'll include a copy of the slide deck. I know we covered a lot of stuff. So first question is, can you qualify on interest only on other programs or just on DSCR?
The answer is yes, you can. Interest only is available across all programs.
Okay, fantastic. What's your minimum and maximum loan amounts?
Well, I think we state the minimum as $150,000 and the maximum of $3 million. Yesterday, I approved a $3.5 million loan and a $1.9 million second home loan to the same borrower, so we do make exceptions. And when we are in the Southeast and the Midwest, we do see loans less than the 150, and we'll consider those as well.
Okay, great. And is stacking available with our bank statement programs and Farm National loans?
Yeah, that's the same question as was answered a bit ago. Well, the stacking is something we do. It's a terrific program once you get to understand how it works. So yes, it's available across all programs. The only thing that limits our stacking is the LTV bucket. We will not stack in the 85 bucket. So if you're looking for an 85% loan, we're not going to be able to stack in that bucket. At 80 and below, we will allow you to stack. And as Mark pointed out, the lower the LTV, the more there is an ability to stack. So you can stack the BPC, broker paid comp, and buy downs. And all of our best salespeople use all of these tools and are very successful in getting very high quality borrowers willing and able to pay the points. You know, I always like to say to people, you know, yes, the borrower is going to pay, whether it be in increased interest rate for a LPC, lender paid comp, or in points, and the borrower has to pay for the loan. So when they ask for a lower rate for a buy down, Mark calls it a rate cutter, you know, they got to pay for that. But the reality of the day is what they're doing is they're using equity. They're using their equity that would just sit there to achieve lower debt costs. So if you think it through, it makes all the sense in the world for the borrowers to do that.
Okay. I want to remind everyone, if you as questions come up, if you think of any questions, go ahead and use the little questions tab so that we can answer them for you. Does rate cutter need to be financed? Can borrower pay out of pocket for the 2-to-1 buy down with an 80% LTV loan and then still finance the 2% borrower paid comp up to 82%?
Yes, the answer is yes. If the borrower doesn't want to finance in some amount of the points, they don't have to. They can, you know, it can be taken out of the cash out if it's a cash out transaction, or if it's a purchase transaction, they can bring those points that are associated with a rate buy down. They can bring those points in, and we can just, you know, use the stacking for the BPC, the amount that you get paid. So. But it varies on every loan. Every loan, as you know, is different. The borrowers have different tastes and appetites, and so it's just handy to know that all of these tools exist. It's a little complicated to start with. Our AEs generally, when they're first starting, they get a little overwhelmed by all of the different moving parts. But when you start to understand all of the moving parts, you begin to turn these things into weapons, and they're very effective when you are selling to your end borrower.
Okay. Do we do short-term rental projects?
Well, I'm not sure I understand what that means. If you're asking me if I do fix and flip financing, the answer is today I do not.
I think they might mean like an Airbnb type thing where people do, you know, have investment properties and they rent them out as short-term.
Okay, if that is the question, the answer is we do, but let's walk through that a little bit. If a borrower can show me history of receiving Airbnb, say across a 18 to 24 month period, and I can see that coming into the bank statements, I'm going to allow you to use that as rents. But if you're buying a new property and you're going to say, I want to use Airbnb rents, and Airbnb comps for this property are 40% greater than what a 1-year lease would be, I'm going to say you got to use the 1-year lease. So we do allow it as long as we can prove that you've actually experienced it, you know how to use Airbnb, and you're effective with the Airbnb, and we can see those things come right into the bank statement. So when we're doing bank statement loans, we see inflows coming from Airbnb all the time. So the answer is yes, but that's a qualified yes.
Okay. And then finally, we're getting a couple of different questions on, how to submit a loan and who is my account executive, et cetera. You can go ahead, when you receive the thank you email from me in about an hour, you can go ahead and reply to me, and I will connect you with your LendSure account executive and get you to connect you with the right people. So let's see. And can you qualify? I think that is. Oh, yes. Will there be a recording of the webinar? Yes. Again, in about an hour, you're going to be receiving a thank you email, and that's going to have the recording of the webinar. I know a couple of you got in late, and it's also going to have a copy of the slides, as well as a link to those private label resources that I told you about. And I think we have one more question coming in, and it says, great, thank you. All right, and I think that is all of the questions. Oh, do your loans have prepayment penalties?
Our investment properties made for business purposes have prepayment penalties on them, anywhere from 1 to 3 years, depending upon the program.
Awesome. All right, and with that, if Mark and Joe, do you guys have any closing comments?
Joe, this is Joe. I would just thank you for your business, and we look forward to doing business in the future with you.
Thank you, Mark.
The only tagline that I'd leave you with is think about future equity, and using that borrower's future equity for stacking borrower paid comp, as well as your ability to buy down interest rates. It's great tools to have. Thanks for listening.
All right. With that, thank you so much, everyone, for joining us today.